Welcome back to the deep dive. If you're looking for this economic heartbeat of India, you usually find it really surging during the festive season. This period, which traditionally runs from those big autumn festivals right through the wedding season, it's just an absolute engine of consumer activity and growth.
It really is. The scale is immense. I mean, you look at last year, the projected festive business soared to, what was it, RS 4.3 trillion?
Yeah, a huge number.
Yeah.
And that was a massive 21% jump over the previous year, with big metro states like Delhi, historically leading that charge.
That cultural phenomenon is, without a doubt, a crucial pillar for the national economy. But as we analyze the sources for this year, the picture is, well, it's far more complex than just simple aggregate growth. We're firmly in what we're calling the cheer with caution scenario.
Cheer with caution. Okay.
So our mission today, really for you, is to drill down into the data and figure out exactly how the average Indian consumer is actually positioned for this massive spending bonanza, and crucially, where that money is and maybe isn't going.
And that framework immediately sets up what feels like the core conflict, doesn't it? It's true that post-pandemic, those big celebratory events, festivals, weddings, they become even more pronounced. People are definitely keen to spend and socialize again.
They absolutely are.
Yet, when we really dissect the source material, we see these two entirely different economies almost running in parallel.
Exactly. That's the key. On one side, you find these significant structural constraints, stagnation, insecurity in formal urban labor markets. That's really limiting true discretionary spending for millions of households. But then that constraint is being offset, almost structurally, it seems, by incredibly robust activity, rising confidence, and, importantly, improved job quality in rural areas and those smaller Tier 2 and Tier 3 cities.
Right, it's that two-speed economy you hear about, but maybe in hyperdrive this year.
Precisely.
Okay, let's unpack this geographical and social split then. Because the big question isn't just how much money is being spent, but why it's being spent. And this is where we need to introduce a couple of critical economic concepts right away, don't we?
Yes, definitely.
Our deep dive suggests that even major policy moves, like the recent GST and income tax cuts, they aren't really generating what economists call the true income effect. That is, massive new aggregate demand.
No, instead they seem to be leading primarily to substitution.
Okay, let's clarify those terms immediately because they sound absolutely central to this whole discussion. What's the difference?
Right. So the income effect is when consumers feel genuinely richer. Maybe their wages went up significantly, or perhaps the tax cut meant they saved enough money overall to justify buying more of everything. That leads to massive new demand across the board.
Okay, more money, buy more stuff. Simple enough.
Yeah. Substitution, on the other hand, means the consumer's total budget isn't necessarily increasing much, but a change in relative prices. Like a specific GST cut on one item prompts them to switch their purchase.
Ah, okay. So instead of maybe buying a new TV and a new couch, they take the tax savings they get on the TV and just buy a bigger, more premium TV instead of the basic model they originally planned.
Precisely that. That substitution effect where you upgrade the brand or you premiumize your planned purchase. That seems to be the key takeaway here.
And that explains why some sectors are booming, maybe high-end electronics or cars, while others, particularly those dependent on just broad mass consumption, are still struggling.
Exactly. And to understand why we're seeing this substitution rather than broad income growth, we have to start where the constraints are hitting hardest, that formal urban labor market.
Okay, so let's dive into that. When we look at the health of the formal workforce, the employees who historically drive discretionary spending in the big metro areas, the news is one of, well, significant moderation and strain, right?
Yeah, the data paints a really clear picture of stagnating corporate compensation growth.
How stark is it?
It's pretty stark. If you look at the corporate wage bill growth for listed companies, say between fiscal years 2020 and 2024, the compound annual growth rate, the CAGR, was quite robust. It was sitting around 12% year over year. That's healthy growth.
12%, yeah, that sounds decent.
But in FY25, our sources indicate that figure slowed dramatically, down to just about 7% year over year.
7%. Okay, on its face, 7% doesn't sound catastrophically low. Why is this figure such a red flag for consumer spending then?
Well, because we have to put it in context, right? Even if that compensation growth may be nudged up slightly in the first quarter of FY26, it remains persistently lower than nominal gross domestic product growth. Nominal GDP was running at about 8.8% year over year in that same quarter.
Okay. So wages aren't keeping pace with the overall economy's expansion, including price rises.
Exactly. If your wages are growing slower than the overall price and revenue expansion of the economy, your real spending power is actually eroding. The consumer feels that squeeze, and that limits their ability to spend much beyond essentials, which translates directly into less enthusiasm for, big festive splurges.
It's not just the growth rate that's problematic, is it? It's also the availability and stability of those jobs, particularly in the big cities. What do the weak hiring trends tell us?
Yeah, the hiring data from the metropolitan centers is genuinely quite alarming. Formal job hiring in major cities is really struggling to keep pace. Mumbai, often seen as the financial heartbeat, actually experienced a contraction in formal
A
hiring.
contraction. Wow.
Oh. And 7 out of the 8 major metro cities recorded hiring growth figures that were below the already pretty low national average, which was only about 6% year over year.
So the very places where we assume the largest concentration of high-income, potentially high-spending households reside, those are the places facing the most significant job market stress right now.
That's exactly it. And that completely explains the urban consumption slowdown we mentioned earlier.
It makes perfect sense.
And this stress isn't equally distributed across the workforce either, which kind of adds to the structural bottleneck we're seeing. We observe that the hiring struggles are most pronounced among workers with less experience, say, the 0 to 7 year cohort.
The younger workers, the ones just starting out.
Right. These are the people who should be entering the middle class, beginning their first major cycle of buying durable goods, cars, appliances. Conversely, workers with higher experience, maybe 10, 12 years, often in specialized or managerial roles, they fared better. They saw growth in the 10 to 12% range year over year.
So what does that disparity suggest?
It suggests that companies are really focusing on retaining or perhaps replacing high-level talent while they're freezing or severely limiting entry and mid-level hiring. It's a cautious approach.
And this feeds directly into a larger and maybe more concerning structural issue that our sources really highlighted. This increasing contractualization, or you could call it the informalization of the workforce within the formal sector itself. Tell us how significant this shift has been.
It is a profound shift, almost a tectonic shift, really, that undermines the stability of the entire organized sector. I mean, just look at organized manufacturing. Back in fiscal year 2000, regular, permanent employees made up about 85% of the industrial labor force.
85%. Okay.
Fast forward to FY23, and that figure has dropped precipitously. It's down to around 67%.
Wow, that's a huge drop. So there's a systematic push by firms to replace permanent staff,
Yeah.
the ones who come with mandated benefits, job security.
Exactly, replacing them with lower paid, temporary contract workers.
So companies are using third-party agencies to hire workers, basically keeping them off the official permanent payroll and avoiding those long-term liabilities. What's the consequence of that for the consumer's pocket and their overall sentiment?
Well, the consequence is a massive wage disparity and just heightened insecurity all around. If you exclude managerial roles, something like 41% of workers in organized manufacturing are now contractual.
41%, nearly half, excluding managers.
Yes. And the salary gap is staggering. This is probably the single biggest reason for that muted mass consumption sentiment we keep talking about. Contract workers are paid about 2.2 times less than their regular permanent counterparts doing comparable work.
2.2 times less. That's enormous.
It is. And that lack of security, combined with lower take-home pay, immediately translates into hesitancy when people are considering, discretionary festive purchases. They just hold back.
That difference is just a colossal drag on the spending capacity of millions of households. But beyond the immediate salary hit, what are the wider implications of this structural contractualization for, say, the average urban family?
Oh, the implications are long-reaching. First, these contract workers often lack access to things like comprehensive health insurance, retirement contributions, and, crucially, stable income verification.
Right, which makes getting loans harder.
Exactly. It makes it far more difficult for them to access formal credit, housing loans, car loans, you name it, which they really need to participate in that middle-class consumption cycle. Second, the constant threat of their contracts simply not being renewed means they inherently prioritize savings and essential spending over impulsive or luxury purchases, no matter how many discounts the festive season offers. It really hollows out the mass consumer base from the bottom up.
And the sources confirm this isn't just isolated to the private sector either. The public sector seems to be mirroring this structural trend as well.
Absolutely. We see this in public sector enterprises, the PSEs. While the total workforce size hasn't changed dramatically since about FY15, the regular workforce, the core, permanent staff, has declined sharply by about 38%.
38% drop in regular staff and PSEs.
Yes. This confirms that the preference for temporary or contractual labor is a widespread structural management decision across both private industry and state-run enterprises. It makes job security a national systemic challenge.
So, for you listening and trying to understand the economic mood, this is the essential context for that urban slowdown. Slowing compensation growth, difficulty for new entrants finding stable roles, and the systemic erosion of job security through contractualization, it really is a recipe for restrained urban spending.
Okay, now let's transition completely. Because when we turn our attention away from those major metro centers, the economic story shifts dramatically. This second part of the economy, the rural and smaller city economy, is showing remarkable, maybe even unexpected, resilience. What's driving this rural advantage?
Well, the foundation of rural demand looks incredibly solid right now. It seems driven by two key factors. A generally positive agricultural outlook, yes, but more importantly, improved quality of employment. We've seen the rural employment rate hit a post-pandemic high, reaching roughly 40% back in August 2025.
40%. But is this just more people returning to subsistence farming, or is the nature of the employment actually changing? That's the key question, isn't it? That is the key question, and the quality is improving. That's the crucial distinction here. We're observing positive momentum in real wage growth, meaning wages adjusted for inflation for both agriculture and the non-agriculture rural sectors. And structurally, salary jobs are now driving incremental job creation in these areas. We saw something like 4.4 million incremental salary jobs added in rural areas in just the first quarter of FY26 alone.
4.4 million new salary jobs in rural India in one quarter. That's substantial.
It is. It indicates a genuine move toward more stable, often higher-paying income sources compared to purely seasonal or casual labor.
And the spending numbers seem to bear this out. We read that rural consumers actually surpassed their urban counterparts in terms of momentum, showing something like a 35% year-over-year growth in average expenditure during the 2024 festive season.
That 35% growth rate is highly indicative of rising confidence. Now, it's important to note metro areas still outspent rural areas by about 40% on a per capita basis, simply because the typical urban salary is still much larger.
Sure, the base is higher in cities.
Right. But the acceleration of growth and momentum is clearly concentrated in the hinterland. And we see a strong proxy for this in the M1 money supply.
Ah, yes. The M1 money supply, that's essentially liquid cash and demand deposits, often used as a proxy for cash-reliant rural activity, correct?
Exactly right. That M1 supply witnessed its fastest growth in 8 quarters, hitting 12% year over year in 1Q FY26. This confirms that liquidity and transaction activity are accelerating rapidly in the parts of the economy that rely heavily on cash, which is consistent with this recovery narrative in agriculture and rural employment.
Okay, but before we celebrate the rural surge entirely, we probably should acknowledge the localized risks. The sources included a necessary cautionary note regarding some recent localized floods, right?
That's right. While the overall outlook is positive, the potential minor blip from localized flooding in some major agricultural regions, parts of Maharashtra, Punjab, Karnataka, were mentioned that can't be ignored. If localized crop damages persist, they could briefly weigh on the non-agricultural rural labor markets that rely on the broader agricultural economy.
Makes sense. A knock-on effect.
Yeah, but the current momentum suggests the underlying structural job growth should probably mitigate any widespread impact. It seems more localized for now.
Okay, let's look at the mid-sized cities then, Tier 2 and Tier 3, which seem to be emerging as true powerhouse growth engines. They seem to be benefiting from both that agricultural prosperity nearby and this modern corporate inflow. What's the structural shift underpinning their success?
Well, the most exciting development here, I think, is the massive growth of global capability centers, or GCCs.
The GCCs.
Right. These are specialized hubs that manage high-value functions, think IT, R&D, finance, for large multinational corporations. Historically, they were almost exclusively chained to the Tier 1 metros. But their share in Tier 2 and 3 cities has just skyrocketed. It's gone from maybe 7% just a few years ago to an estimated 15% to 20% in FY25.
15 to 20% share now in Tier 2 and 3. Why are these GCCs shifting to smaller centers now? What's the driver?
It seems to be a combination of factors. Talent saturation and rising costs in the metros is one. But also, companies realize they could access equally skilled, sometimes younger and perhaps more loyal, talent pools in places like Visakhapatnam, Ranchi, or Jaipur, and do it at a significantly lower operational cost.
Lower costs, good talent. It makes business sense.
Absolutely. And the projections are significant. We're expecting up to 140 new GCCs in these kinds of cities over the next 5 years. This isn't just about creating jobs, it's about establishing local hubs for high-paying, formal, future-proof employment in these regions.
That kind of inflow must dramatically change the local economy. You're talking about highly competitive labor markets developing in places that traditionally haven't had them on this scale.
It is causing a localized hiring boom that the metros can probably only envy right now. Temporary jobs in Tier 2 cities grew by a staggering 42% year over year. 42%. And compensation reflects this demand. Salaries in Tier 23 cities are projected to increase by somewhere between 18% and 22%. Compare that to the 12% to 15% increases expected in Tier 1 cities. The gap is widening in favor of smaller cities.
18 to 22% salary growth in Tier 23. That's huge.
It is. And staffing firms estimate that these regional shifts will fuel over 216,000 temporary jobs nationally, many driven by this trend.
Now, for you listening, the tangible proof of this economic shift is really undeniable when you look at the e-commerce data, isn't it?
Absolutely. E-commerce is the perfect litmus test for discretionary spending power and confidence. During recent major sales events, e-commerce volume growth in Tier 2 and 3 cities was about 4 times higher than in the metros.
4 times the growth rate.
Yeah. Flipkart's Big Billion Sales, for instance, they saw volumes multiply 4-fold in these regions. And Amazon Prime Day saw 70% of its new customer signups originating from Tier 2 and Tier 3 centers.
70% of new signups. So not only are they spending more, but new consumers are entering the whole e-commerce ecosystem at an accelerated rate from these areas.
Yeah.
That really demonstrates a foundational shift in consumption habits.
And their financial health seems to back this up, too. Deposit growth moderation, which can be a sign of changes in savings rates, was significantly steeper for metros. It fell from 15.4% growth down to 12.2% year over year.
Okay.
By contrast, major Tier 23 cities saw a much milder drop, maybe from 12% down to 10% year over year. It suggests they're more financially stable right now, and they're growing their deposit base faster overall.
This evidence really brings us full circle back to the urban slowdown, doesn't it? When you have this concentration of stability and high wage growth happening in smaller cities, it's maybe no wonder that Tier 1 cities are seeing strains reflected in those luxury consumption segments like high-end passenger vehicle sales, SUVs and MPVs, and even real estate, which have apparently slumped over the past 5 quarters in the metros.
Exactly. The contrast is becoming quite sharp.
Okay, let's pivot now to policy. In an effort to inject some significant spending power into the festive season, the government enacted those major GST and income tax cuts. They were estimated to cost the Treasury somewhere between Rs 1.9 and 2 trillion in lost revenue, a huge amount.
A very significant fiscal move.
And the clear intention, presumably, was to spark a massive aggregate demand boost, that income effect we defined earlier.
Yeah.
But this is where the policy seems to have met the structural reality of the labor market head-on.
Indeed. The core finding of our sources is that because of that widespread stagnation in formal urban job markets and the contractualization issue we detailed, these tax cuts are primarily triggering substitution, not the desired income boom. Consumers are generally, it seems, still cash constrained, maybe debt burdened, so they can't easily increase their total spending footprint.
But they can change what they buy within that footprint. Let's explore that substitution effect more deeply. What does it look like on the ground?
Well, it often looks like premiumization. The anecdote from those channel checks in Uttar Pradesh is a perfect example. You had a consumer who budgeted for, say, a basic 100cc two-wheeler. After the GST cut lowered the effective price of a slightly more premium 125cc model, the consumer didn't go out and buy the 100cc bike and a new fridge with the savings. No, they simply upgraded their planned two-wheeler purchase to the higher spec model.
So the total spending budget remained largely fixed, but the quality or the value of the purchase improved.
Exactly, premiumization.
So the policy succeeds in shifting consumers up the value chain, potentially, but fails to unlock massive new demands from the bottom up.
Okay, so where did these GST cuts work well then? Which sectors clearly benefited?
They worked exceptionally well for high-ticket items, specifically durable goods and passenger vehicles, PVs.
Why them in particular?
Well, a couple of reasons. First, the price cuts are highly visible in absolute rupee terms. A few percent off a car is a noticeable amount of money. Second, and crucially, these purchases are often financed.
The financing angle. Yeah. So that slight reduction in the sticker price becomes a powerful psychological trigger for taking on new debt or using existing financing options. It makes the monthly payment look a bit better.
And the cuts were most dramatic on items previously taxed at that highest 28% slab, right? Things like cars, ACs.
Correct. Items like cars, air conditioners, large screen TVs, they saw price reductions in the range of approximately 3% to 10%. When you're talking about a purchase costing, say, 5 lakh rupees, even a 5% drop is tangible. It's Rs 25,000. It feels worth acting on.
And we have hard data showing the immediate success in these segments, don't we?
Absolutely. The sources noted an immediate and massive spike in sales for PV makers. Think Maruti, Hyundai, Tata, right after the cuts were announced back in September. Sales immediately following that GST reduction were approximately 50% higher than the typical non-festive season sales figures for those companies.
50% higher. Wow. Okay. That confirms a rapid, favorable response, definitely driven by the visible price change. It really validates that substitution thesis for big items.
It does.
Conversely, though, if high-ticket items benefited so much from substitution, why are small-ticket items, your everyday fast-moving consumer goods, FMCG, showing such sluggishness? Where is the policy transmission failure happening there?
Yeah, this is where those muted sentiments among lower-income households are the ones often struggling with contractual labor or slow wage growth really cripple the policy's effectiveness for mass-market goods. For, say, the bottom 40% of the population, reducing GST rates from maybe 12% down to 5% on some items, that translates into an increase in their personal disposable income of only about 2%.
2%, that's negligible, isn't it? Not really motivating.
Exactly. It's a non-motivating change in their overall budget.
It must be an issue of scale and visibility, too, right? If you buy a small packet of biscuits for Rs 10, the tax saving is literally pennies.
Precisely. The savings on low-ticket daily essentials are so small that communicating the benefit to consumers becomes nearly impossible. Why would you change your behavior for a saving you can barely see? And this problem is compounded by what seems to be a serious consumer trust gap. A survey conducted around the time of the cuts, September 22nd, revealed that only about a quarter, just 25%, of surveyed consumers were actually confident that prices would decrease after the GST cuts were announced.
Only 1 in 4 believe the prices would actually drop.
Yes. So if 3 out of 4 consumers don't trust the price will fall, they simply won't change their purchasing habits based on the announcement.
And their skepticism seems somewhat justified, given the evidence that came out about retailer non-transmission. Companies or retailers often failing to pass on the full benefits, maybe using excuses like old stock or confusing tax tables.
Well, yes, and the most concerning evidence was that some manufacturers seem to be actively absorbing the tax cut by simply raising the base price of the product.
Raising the pre-tax price.
Yes. Consider that popular biscuit brand cited in the sources. The GST rate on it dropped significantly from 18% down to 5%, a big drop. However, analysis showed the manufacturer simultaneously increased the base price by about 9 rupees per packet.
Wait, so the company essentially pocketed most of the intended consumer benefit by adjusting its pre-tax pricing.
That's exactly what appears to have happened in that case. The net result for the consumer was a saving of only about 4 rupees per packet rather than the much larger drop the tax cut implied.
Huh?
And when this kind of thing happens across the board for mass consumption items, that enormous government expenditure on tax cuts ends up, boosting corporate profitability or maybe just stabilizing manufacturer prices against other cost increases rather than fueling a broad-based consumption boom from the ground up.
It really reinforces that idea. The consumer is getting premiumization on big things, maybe, but not a sustained lift in overall purchasing power for everyday items.
Okay, shifting gears again, let's look at the very foundation of all consumption, the household balance sheet. Our sources highlight what seems like an alarming trend of leveraged debt dramatically outpacing income growth. This has to raise serious questions about the sustainability of the current consumption cycle.
It really does. The growth in household debt is a major structural concern right now. Between just FY23 and FY25, per capita household debt increased substantially. It moved from around Rs 390,000 to Rs 480,000 per person.
480,000 rupees per capita, and this expansion of debt is happening much faster than the economy's ability to generate steady, high-quality income.
That's the worrying part. The gap in growth rates is significant. Household debt grew at a compound annual growth rate of about 14.7% between FY20 and FY24.
Okay, nearly 15% per year. Yeah. In the same period, nominal GDP grew at a slower 10.6%, so debt is growing much faster than income. This reliance on leveraged consumption borrowing money to buy things now has really been the central narrative of the post-pandemic recovery, hasn't it? The party, to some extent, was funded by credit.
But when we talk about this debt, is it mostly people buying homes? What you might argue is healthier, maybe wealth-generating debt.
Unfortunately, no. The debt profile is skewed towards riskier types of credit. Approximately 55% more than half of total household debt is classified as non-housing retail credit.
55% non-housing, what does that include?
That includes things like unsecured personal loans, credit card debt, financing for consumer durables like phones and TVs. This high proportion of non-housing debt highlights a clear reliance on credit-fueled discretionary spending, which makes the consumer balance sheet extremely fragile in the face of any income shocks or potential interest rate rises.
And this brings us to a crucial, almost real-time indicator of consumer stress, the UPI data on debt repayment. The sources suggested a worryingly high fixed financial burden.
Yeah, the high fixed costs for an average family rent, health, education, transport, they already consume maybe more than 2/3 of their spending capacity. That's before any discretionary spending. But the UPI data provides this unprecedented granular look at financial stress. For the first 4 months of FY26, approximately 13% of all UPI payments made were specifically targeted toward debt repayment.
13% of every single digital transaction is just servicing existing debt. That's a truly staggering figure. It's a profound insight into how thin the financial margin must be for many consumers right now.
It really suggests the consumer is kind of running on a treadmill, just trying to keep up with existing obligations. Furthermore, when analysts looked at spending growth on UPI, 7 of the top 10 contributors to that growth were related either to debt repayment or essential non-discretionary items like groceries and utilities.
So most of the increase in spending is going towards paying debt or buying absolute necessities.
Exactly. It means an overwhelming portion of consumer income is already committed before they even think about festive shopping. It leaves very little room for true discretionary spending, even if that new television looks cheap after a GST cut. If you're struggling to service your existing debt, you're probably not engaging in many festive purchases.
This vulnerability, this stress, has inevitably led to financial institutions becoming far more cautious, hasn't it? Meaning the credit taps that arguably fueled the recovery are now tightening up.
Precisely. Banks and the non-banking financial companies, the NBFCs, they are now significantly more cautious. You have rising delinquency rates in some segments, coupled with regulatory tightening intended to safeguard the financial system. And the result is they're reducing their exposure to riskier borrowers. They are actively trimming down loan sizes or outright refusing loans to new customers more often.
And how do we actually see this caution reflected in the lending data?
Well, it's evidenced quite clearly by the falling share of new-to-credit customers. These are people applying for their very first loan. Their share is dropping across personal loan segments, including financing for things like two-wheelers and consumer durable goods.
So the system is becoming less welcoming to first-time borrowers.
Yes. That high-risk, high-growth consumption model that relied on bringing millions of new borrowers into the formal credit system, that's being deliberately slowed down by lenders now.
So for you listening, this means the two potential engines of festive cheer, visible price drops via GST cuts, and easy credit to facilitate the purchase are fundamentally fighting against each other right now. The GST drives substitution, maybe, but the credit squeeze limits the ability for many to substitute or premiumize, especially if they're new borrowers or perceived as risky.
That's a very good way to put it. The two forces are working in opposition for a large segment of the population.
Now, beyond these domestic issues of labor markets and debt, we also have to acknowledge some significant external risks looming. Tell us about the structural threat posed by those recent U.S. tariffs on India's labor-intensive export sectors.
Yeah, these tariffs introduce a major structural headwind. They specifically target industries that employ huge numbers of low and middle income workers. We're talking about sectors like leather, textiles, gems, and jewelry. They're now facing potential duties as high as 50% in the U.S. market.
50%. That's existentially crippling.
It's an existential threat for many firms in these sectors, particularly because the U.S. accounts for at least 20%, sometimes more, of their total export markets. Immediate diversification on that scale is extremely difficult, if not impossible.
And this translates directly and quickly into job losses, doesn't it? Feeding right back into that insecurity narrative we saw in Section 1, but maybe focused on specific geographical clusters that are heavily dependent on these exports.
Absolutely. The channel checks mentioned in the sources suggest that massive layoffs are highly probable if these tariff issues aren't resolved quickly. Consider the human impact. The gems and jewelry sector, for example, is concerned about something like 1.7 lakh skilled workers being affected. And they note that 85% of their exporters are small and medium enterprises, MSMEs, who simply cannot weather a prolonged revenue loss like this.
1.7 lakh workers potentially affected just in gems and jewelry. And we're already seeing the consequences on the ground in specific industrial belts, aren't we?
Yes, sadly. The sources point specifically to the leather industry in the Ambit belt of Tamil Nadu, which is a major export hub for leather goods. Hundreds of factories there have apparently already been forced to shut down entirely or substantially reduce operations,
Hundreds of factories closing.
or scaling back significantly. Workers there are facing extreme financial hardship, including reports of widespread unpaid leave. This kind of localized economic fragility completely dampens any festive optimism in those specific export-dependent regions. It creates pockets of real distress.
Okay, now let's look internally again, just briefly. How are manufacturers responding to this mixed picture of cautious cheer, high debt burden, and these external risks? The sources suggest firms are maybe not fully confident enough to really ramp up production in anticipation of a massive, broad-based festive season boost.
Yeah, their caution is written quite clearly in the industrial production data. While the Purchasing Managers Index, the PMI, showed positive sentiment among manufacturers about future output. They hope things will improve. The actual production data tells a more cautious story right now. The Index of Industrial Production, the IIP, specifically for non-durables, which covers things like FMCG, toiletries, mass market food products, that has actually shown contraction on a year-over-year basis for the first 5 months of FY26.
Contraction in non-durables. That's basically the antithesis of a mass consumption boom, isn't it?
Precisely. It signals that manufacturers are anticipating weak consumption demand from those middle and lower income segments that typically purchase these everyday goods. And this IIP non-durables contraction is reportedly led specifically by a steep contraction in food products, which is a key necessity purchase. It just reinforces the expectation that spending will be concentrated in those high-value, substitution-driven durable goods rather than a broad, healthy consumption boom across daily essentials. Firms are basically hedging their bets against the weakest consumers. Hashtag tag conclusion and final takeaways.
Okay, let's try and synthesize this really complex outlook for you, the listener. This deep dive has absolutely detailed India's two-speed economy during this crucial festive season. On one side, we have these clear structural pressure points: lagging metro consumption, a stagnant and increasingly precarious formal labor market defined by that contractualization trend, sluggish mass consumption segments like FMCG, and a definite tightening of vital credit access, especially for new borrowers.
Right. But conversely, the growth drivers are also distinct and quite powerful in their own right. Tier 2 and Tier 3 cities are genuinely emerging as hubs of high-wage formal employment, largely thanks to that GCC shift. Rural resilience looks robust, driven by strong agriculture and, importantly, that salary job growth. And finally, high-value discretionary spending is surging, but it seems almost entirely due to that substitution effect caused by those visible GST cuts on big-ticket items.
So if you were forced to identify the clear winners in this very selective spending environment, who benefits most according to the data we've discussed?
Well, the biggest beneficiaries seem to be the sectors benefiting from both the GST cuts and the rural recovery. So autos and two-wheelers, you think of major players like Mahindra and Mahindra, Eicher Motors, EIM, they look well-positioned due to the combination of reduced prices and improved rural sentiment.
Okay, autos and two-wheelers. What about on the premium and maybe the local side?
Hotels and premium discretionary segments seem highly resilient. They're benefiting from broader trends, maybe like the growth in religious and spiritual tourism that's been noted. And we'd also expect value retail chains, the ones with high penetration in those booming Tier 2 and 3 cities, they should be well placed to capture a significant portion of that localized, accelerating growth.
Sounds like the overall economic momentum will certainly be positive this festive season, but it's going to be highly selective and geographically very uneven.
That is the ultimate summary, I think. The festive boost is real, yes, but it's fundamentally a story of internal demand shifting geographically away from the largest metros towards the hinterland and smaller cities, and shifting structurally away from generic mass consumption towards more premium products driven by substitution. It's perhaps an upgraded economy in parts, but not necessarily a broadly richer one overall. And this selective boost, while welcome, likely won't be enough on its own to significantly raise overall GDP growth metrics beyond maybe a single quarter's impact. It's a fascinating, really nuanced picture. We've unpacked why consumer confidence can simultaneously be improving nationally, according to some surveys, while remaining deeply muted for millions of lower income groups, and how those government tax cuts are currently driving premiumization, that substitution effect, instead of the hoped for true income effect.
Which brings us, I think, to the crucial long-term structural question that's kind of hidden beneath this surface of festive cheer. We detailed that structural shift towards precarious contractual labor, highlighted by that shocking 2.2 times salary gap. We talked about the extremely high debt burden consumers are carrying, evidenced by that incredible 13% of their UPI payments just going to service existing debt.
Yeah.
So if income growth continues to lag behind this leveraged consumption model, and if the formal workforce becomes increasingly precarious, and if the credit taps remain tight, especially for those perceived as higher risk, what happens to the next cycle of discretionary consumption? When the current consumer debt is finally repaid or defaulted on, and there isn't easy credit available to kickstart the next round. That is the crucial challenge, isn't it? The one that will define India's structural consumption story long after the immediate festive glow fades.
Precisely.
That is the essential long-term question for you, the listener, to mull over. Thank you for decoding India's complex two-speed cheer with caution economy for us today.
A pleasure, as always.
And thank you for joining us for the deep dive. We hope this shortcut to knowledge helps you navigate the intricacies of the festive season's economic data. Until next time.